Four things just happened in less than 48 hours. Gold exploded to $5,494. Silver surged to $120. Geopolitical escalation around Iran's nuclear posture moved from strategic ambiguity to operational tension. And multiple global exchanges either halted, limited trading, or experienced liquidity strain. Individually, each headline is dramatic. Together, they form a structural signal. This is not a normal flight to safety bid. Safe haven flows do not double silver. Safe haven flows do not trigger exchange instability. Safe haven flows do not fracture future spreads and push physical premiums into disconnect. When metals move like this, they are not reacting. They are a pricing risk. And the risk being repriced is not just war. It is currency credibility. It is sovereign balance sheets. It is derivative exposure layered on top of thin physical inventory. It is policy constraint colliding with geopolitical shock. Mainstream coverage will frame this as panic. That's convenient. But panic is chaotic. This was mechanical. Call options were lifted aggressively. Market makers hedged. Gamma accelerated upside. Liquidity thinned. Futures spreads inverted. And the physical market tightened simultaneously. That combination is rare. Because what you're watching is not emotion. You're watching stress move from the geopolitical layer into the financial plumbing. By the end of this analysis, you'll understand why this move is less about Iran and more about the global monetary regime. Why silver's structure makes it exponentially more unstable than gold. Why miners may be signaling something the futures market is ignoring. Why physical market divergence matters more than spot headlines. And why exchange closures tell you more than price ever will. This is not about chasing a headline. This is about recognizing alignment. Policy, corporate behavior, physical demand, derivatives mechanics. When those four align, volatility regimes shift. Let's break it down. Policy, government action. The catalyst was geopolitical escalation tied to Iran's nuclear posture. Whether it was enrichment acceleration, regional military response, or strategic repositioning, the implication was clear. Energy corridors are now risk assets. When oil transit routes become uncertain, inflation expectations move immediately. Higher expected energy costs ripple into transport, manufacturing, agriculture, and defense spending. Central banks are already constrained. Policy rates remain elevated relative to prior decades. Debt to GDP levels across developed economies exceed historical stress thresholds. Governments cannot afford a new inflation spike. But they also cannot afford a liquidity freeze. This is the trap. If geopolitical escalation sustains higher energy pricing, our inflation expectations rise, bond yields face upward pressure, fiscal deficits widen, currency confidence weakens. Gold reacts first to currency credibility. Silver reacts to both inflation and industrial risk. Now add sanctions risk, reserve diversification, and sovereign positioning. When geopolitical fragmentation increases, reserve managers quietly rebalance. Gold becomes neutral collateral, not ideological, strategic. That is why gold's move was not gradual. It was decisive. The market began pricing policy paralysis. Because if inflation resurges while growth slows, central banks have limited maneuverability. And when policy flexibility compresses, metals expand. Corporate earnings minus signal. Now let's examine miners. If gold truly moved to $5,494 and silver to $120, miner margins expand dramatically, on paper. But earnings quality matters. Two possibilities exist. Possibility 1, miners are simply benefiting from higher realized prices, cash flow surges, balance sheet strength and capex expands. Possibility 2, input costs are rising alongside metals, energy, labor, equipment, geopolitical risk premiums. Margins do not expand proportionally. Which is more likely? Historically, during sudden metal spikes tied to geopolitical stress, input costs rise but lag price spikes. That means new-term margins often expand sharply. But here's the nuance. If silver outperforms gold, primary silver miners benefit disproportionately, especially those with fixed cost bases. However, many silver miners are byproduct producers tied to base metals. If industrial slowdown emerges due to geopolitical shock, copper and zinc demand may soften. So earnings dispersion increases. Watch realized price versus benchmark. Watch all-in sustaining costs. Watch forward guidance language. If miners begin hoarding cash instead of expanding production, that signals they do not view this as temporary. That matters, because corporate behavior often confirms whether a spike is cyclical or structural. Physical market evidence. This is where narrative meets reality. Futures prices can spike on leverage. Physical markets cannot fake tightness for long. Key indicators. A retail dealer premiums, wholesale bar availability, refinery throughput, delivery wait times, international arbitrage gaps. When silver surges this fast, inventory strain becomes visible quickly. If premiums widen despite rising spot, that indicates real demand. If delivery times extend, that signals strain. If Asian or Middle Eastern pricing diverges from COMEX benchmarks, that implies regional accumulation. Industrial buyers complicate this. Solar manufacturers, defense contractors, electronics producers. They do not speculate. They secure supply. If geopolitical risk threatens shipping lanes or refinery capacity, industrial buyers forward contract aggressively. That tightens float. And silver has a small float relative to paper claims. This is critical, because silver's derivatives market is enormous relative to registered inventory. Which brings us to the most misunderstood layer. Derivatives, futures, options pressure. Here is where moves like this accelerate. Open interest in metals futures often represents multiples of deliverable supply. Most contracts settle in cash. Few demand delivery. That works until volatility spikes. Now add options. When out-of-the-money calls are aggressively purchased, dealers hedge by buying futures. As price rises, delta increases. Dealers buy more. That's gamma feedback. If open interest expands during price acceleration, the move feeds itself. But here's the constraint. Registered inventory does not expand overnight. If even a small percentage of contracts stand for delivery, stress emerges. Is mass delivery probable? Rarely. But stress in the delivery mechanism increases volatility premium dramatically. Exchange halts or liquidity limitations often occur not because metal is unavailable, but because margin systems struggle to adapt fast enough. Clearinghouses raise margin requirements. That forces leverage shorts to cover. Covering fuels upside. It becomes reflexive. Gold can absorb this better due to deeper liquidity. Silver cannot. Which explains the magnitude differential. The unified thesis. Now connect it. Policy constraint reduces central bank flexibility. Geopolitical escalation increases energy uncertainty. Energy uncertainty raises inflation expectations. Inflation expectation pressures sovereign credibility. Gold prices currency fragility. Silver prices currency fragility plus industrial risk. Option structure amplifies upside through gamma hedging. Thin physical float increases volatility. Exchange systems strain under velocity. Miners signal margin expansion, but hesitate on long-term expansion. That combination is not random. It is alignment. And alignment produces regime shifts. This does not guarantee permanence, but it dramatically raises the probability that we are transitioning from a low-volatility monetary regime to a structurally unstable one. And metals are historically early indicators of that shift. Let's slow this down and bring everything back into focus. Because when price moves this violently, emotion tries to take over the narrative. But emotion is not analysis. Structure is. We just walked through 4 critical signals. Policy constraint. Miner behavior. Physical market evidence. Derivatives pressure. Individually, each one matters. Together, they form a pattern. Policy. Geopolitical escalation tied to Iran's nuclear posture didn't just create headlines. It forced governments into a narrow corridor. Energy risk increases inflation volatility. Inflation volatility reduces central bank flexibility. And when central banks are boxed in, currency confidence becomes fragile. Gold does not explode to $5,494 because investors are excited. It moves because confidence is recalibrating. Silver does not hit $120 because retail traders are enthusiastic. It moves because monetary stress and industrial necessity collide in a thin market. Miners. Corporate behavior is often the most honest signal in the system. If producers suddenly experience record realized prices, their reaction tells you how durable they believe the move is. Do they aggressively expand production? Do they hedge forward at current levels? Do they conserve capital? Do they accelerate debt repayment instead of growth? If management teams prioritize balance sheet strength over expansion, that signals caution. And caution at record prices suggests they do not view this as a short-lived spike. Watch guidance. Watch capital allocation. Watch insiders selling versus insider accumulation. Executives do not trade narratives. They trade probabilities. The physical layer. Futures can overshoot. Physical cannot fake scarcity for long. If dealer premiums remain elevated, if delivery timelines stretch, if refineries report backlog, if international markets detach from Western benchmarks, that tells you real supply-demand imbalance is forming. Silver's structure makes this particularly important. A large percentage of annual supply is consumed industrially. Solar, electronics, medical applications, defense components. These buyers do not wait for dips. They secure inventory when risk rises. If geopolitical instability threatens logistics or refinery throughput, industrial procurement departments move early. That tightens float. And when float tightens in a market with massive paper exposure, volatility increases nonlinearly. Derivatives. This is the layer most misunderstood. Open interest in futures often represents multiples of deliverable supply. Under normal conditions, that works because most participants settle financially. But when volatility spikes and call options are aggressively accumulated, market makers must hedge dynamically. As price rises, they buy more. As they buy more, price rises. That feedback loop accelerates. If clearinghouses increase margin requirements during the move, leverage shorts are forced to cover. Fast covering fuels upside. This is mechanical, not emotional. Now step back. What do these four signals collectively imply? They imply stress transmission. Geopolitical stress moved into energy expectations. Energy expectations moved into inflation projections. Inflation projections moved into bond market sensitivity. Bond market sensitivity moved into currency fragility. Currency fragility moved into metals. Metals moved into derivatives feedback. Derivatives stress-pressured exchange liquidity. This is not random volatility. This is led transmission. Over the next 6 to 24 months, the path depends on stabilization or escalation. Scenario 1. Geopolitical tensions de-escalate. Energy corridors stabilize. Inflation expectations compress. Central banks regain credibility. Real yields rise modestly. In that scenario, metals likely retrace part of the move. Volatility compresses. Silver underperforms gold as industrial optimism normalizes. Scenario 2. Fragmentation deepens. Sanctions expand. Energy markets remain unstable. Fiscal deficits widen as governments respond defensively. Central banks face renewed inflation pressure while growth slows. In that environment, gold establishes a structurally higher base. Silver remains volatile but benefits from both monetary demand and strategic industrial stockpiling. There is also a third, less discussed possibility: liquidity fracture. If exchange stability continues to show strain, regulators may intervene more aggressively. Margin changes, position limits, temporary trading suspensions. These actions can suppress volatility short-term, but they do not eliminate underlying structural tension. They postpone it. What matters most is not the absolute price printed this week. It is whether trust in policy management erodes. Gold historically performs best not during chaos alone, but during doubt about leadership response. Silver historically performs best when monetary uncertainty overlaps with constrained supply. Right now, we see elements of both. But conviction must remain disciplined. Parabolic moves often retrace. Leverage exaggerates extremes. Sentiment shifts quickly. The goal is not to chase. It is to interpret. If you strip away the noise, here's the core thesis. When geopolitical risk rises at the same time fiscal systems are stretched and derivatives exposure is elevated, metals become the pressure valve. Sometimes that pressure release is temporary. Sometimes it marks regime transition. We are at an inflection point where both outcomes remain possible. That is why independent thinking matters. Do not outsource your judgment to headlines. Do not anchor to price targets without understanding structure. Study bond yields. Watch energy volatility. Track minor capital allocation. Monitor open interest versus registered inventory. Observe premium behavior in physical markets. These indicators will tell you whether this was a spike or a shift. Because the market is not just pricing Iran. It is pricing fragility. And fragility does not resolve overnight. It either stabilizes through credible policy action, or it compounds. In every major monetary transition in history from the inflationary 1970s to post-crisis quantitative regimes, metals moved before consensus adjusted. They did not wait for confirmation. They anticipated imbalance. That does not guarantee repetition, but it establishes precedent. The responsible stance here is neither panic nor euphoria. It is vigilance. If gold holds elevated levels despite attempts to suppress volatility, that signals deeper concern. If silver maintains strength even as headlines fade, that suggests structural demand. If miners resist aggressive hedging, that reveals expectation. If derivatives open interest expands instead of collapsing, that implies positioning is not yet exhausted. These are the signals to watch. Not social media sentiment. Not dramatic thumbnails. Not price predictions detached from context. Remember, markets close when liquidity cannot keep up. Markets reopen when systems adjust. But trust, once shaken, rebuilds slowly. The reason this moment feels significant is not just the magnitude of the move. It is the alignment of layers. Policy constraint, industrial necessity, monetary fragility, derivative leverage. Alignment changes regimes. And regime changes redefine price floors. The coming months will reveal whether this was a volatility spike driven by gamma mechanics or the early stage of a broader monetary repricing cycle. Either way, something important has already occurred. Metals forced the system to react. Exchanges adjusted. Clearinghouses recalibrated. Governments issued statements. That tells you the move mattered. So step back. Stay analytical. Recognize uncertainty without being ruled by it. Because in environments like this, the winners are not the loudest voices. They are the most prepared minds. Gold at $5,494. Silver at $120. Markets closing. Those are outcomes. The real story is the structure underneath them. And that structure is shifting. The question is not whether volatility will continue. It is whether stability can be restored. And that is a macro story still unfolding.